I didn't think the pain from the shingles rash would affect simple, everyday tasks like bathing, getting dressed, or even walking around. I was wrong. Though not everyone at risk will develop it, 99% of people over the age of 50 already have the virus that causes shingles, and it could reactivate at any time. I developed it, and the blistering rash lasted for weeks. Don't learn the hard way, like I did. Talk to your doctor or pharmacist today. Sponsored by GSK.
Reality radio for a really great future. We're talking real money.
Well, it's the question and answer edition of Talking Real Money coming your way. Goes up on Friday, so we call it the Friday Q&A. Hey, everybody, I'm Don McDonald. Thank you so much for listening to our podcast and for all the great questions, because we really are getting a lot of great questions, and I like that. It allows me to do like I'm going to try and do today, and that is fit 6 questions in to the podcast. 6 questions. I don't know that I've ever done a 6-question Friday. I might have done one. So we're going to do one now. Now, if you want to ask questions, there are several ways to do it. The one that most people use is just going to talkingrealmoney.com, clicking the Contact Us button, and then either typing in a question, which way too many of you do, or speaking it in, which allows me to do them on this edition of the program. So speak them in if you want them on the Friday edition. Type them in if you want them some other time. Tom gets that pile, and I don't know what happens to them. We eventually answer them. Or there's a third way. Every single Saturday, unless it's a major holiday on the day, Tom and I try to get together to spend a great deal of time during our live radio show in Seattle on Northwest News Radio, answering your questions. And we do that every Saturday from 3 p.m. until 5 p.m. Eastern. And the phone number for that show is 855-935-TALK, 855-935-8255. So many opportunities to get your questions answered, and we love doing it. See, that's the thing, is that this is our favorite part of the show. And it's funny, looking at the numbers, at the downloads, it's also your favorite part. More of these episodes get into the top 10 downloads than the others. So thanks. Now, we have a great question to start things off. Here it is.
Hi. Thank you so much for taking my question. This is Rachel in North Carolina. And I have a dear friend who's recently been sold a universal flexible premium life insurance policy. I've always heard to stick with term life insurance policies. They're paying at a minimum $7,000 a year. It's for a $1 million policy, and they're being told to increase it in future years up to as much as like $20,000. There's obviously the cost that's going towards the policy, and then also apparently money's going towards like investing, and that if at some point they want to take money out, they can. It just makes my stomach turn. I'm trying to explain it to them. I'm just wondering if you have a better way of explaining it, and maybe I'm completely wrong. So I would love to hear your thoughts. Thank you.
Rachel, you're not completely wrong. As a matter of fact, you're about as right can be. The only thing I regret is that I don't have more details so I could actually look up the company itself. But Universal Life is something that I'm very familiar with because it's sold. By the way, sold. I don't think people go out and seek out variable universal life. They just don't. Because, well, you didn't give me the age of the person, but let's just assume that this person is a 40-year-old, non-smoking, healthy male person. In this day and age, that person could get a 20-year fixed term policy locked in, $1 million. Are you ready? About $600 a year. You said they're paying $7,000 for the universal life policy? Let's break down where that money might be going, shall we? Well, the typical first-year commission for a universal life policy is, well, on $7,000, it's probably somewhere between $3,500 and $6,500 in year one. So the first year, pretty much all of it goes to the agent. So you've got to stay for a while for the insurance company to start making money. And then after that, the commissions are about 3 to 10% of whatever the premium is the next year. But how does this all work? It's very, very complicated and confusing, as is the rest of the insurance industry. So let's try to rough out the numbers, shall we? I mean, I'm going to rough them out because I don't have specifics on this policy. But these are pretty typical, these charges. So let's look at that first year. $7,000 goes in. Commissions, $3,000 to $6,000. The insurance going to cost you, all of those insurance costs and expenses, somewhere between $500 and $1,500. That's for the actual death insurance and the costs of managing the policy. So where does that leave you? Well, that leaves you with maybe at most about $1,500 going into the investments. No, that's not a very good deal. Oh, but it gets better the second year. The annual fees and the continuing commission and all. So we're looking at about $1,000 to $2,000 a year. So your cash contribution maybe $4,000 to $5,000 a year. What does it earn? Typically on these kind of policies, there's either a declared interest rate, which generally is in the 3 to 4% range, or they index link the returns. Link is the key word. Because they give you the return of some index, but there are caps on how much they'll give you. There's a percentage. It's called the participation rate, and there are some spreads and things like that. So roughly, let's say in 10 years they put in $70,000. At the end of 10 years, probably have between $35,000 and $50,000. Or you could get term life and pay $500, $600 a year and have invested that $6,500 every month. At the end of 10 years, even without earning any money on your money, you would have probably had more money than using the insurance, the universal, I should say, life insurance. These are sold, not purchased. These are not good deals. They are pitched and they are lucrative for the person doing the pitching. And the argument is, well, why not rent life insurance? Why not buy it? That's just a dumb, spurious argument. That's like, well, why rent homeowners insurance? Why not do cash value? How come there's no cash value homeowners insurance? Oh, I shouldn't give them any ideas. I mean, you buy insurance to protect against something bad happening. The minute the insurance companies start adding complexity to it, they're generally doing it for the express purpose of making themselves more money, not you. Otherwise, these things wouldn't be so confusing. Is this a good idea? It's a horrible idea. These are terrible products. Again, they overpromise, they're oversold, they underperform. Unless you have a need for some sort of a permanent life insurance situation, and that's rare, by the way. Most people only need temporary life insurance to protect against the loss of their income when they're younger until they've built up nest eggs. If you've got millions of dollars in your portfolio, and you die, well, your heirs will get those millions of dollars. It's like you're self-insuring, isn't it? Anyway, thanks so much for your call. Terrible, terrible idea. Suggest they go find some nice, inexpensive level premium term. Now let's go to the next question.
Tom and Don. The Roth income limit for 2025 is $236,000. We might be right up against the limit, and while I know you can make an IRA contribution in 2026 for the 2025 tax year, what I'm looking to know is if I would be able to make a non-deductible contribution in 2026 and then convert it to Roth in 2026 for the 2025 tax year. Thanks.
You were doing really well up to that for the 2025 tax year thing. Now I'm going to have to parse the heck out of this. So, yes, you can make a non-deductible IRA contribution in 2026 for 2025, and you can convert that to a Roth under the backdoor IRA rules anytime you want after that. But you're not converting it into a Roth for 2025. No. You're just converting it into a Roth for whenever. So I'm not sure what you're trying, but kind of, sort of, yeah, you can do it, except for some details like the 2025 tax year thing. That you can't do, but you can do it. You can do the non-deductible. You can do the Roth conversion based on the pro rata rules. So, yeah, kind of. The answer is kind of yes. It's not exact, but that's as close as I'm going to get. And if you have a question, well, we want you to send them to us so we can get close to those. And the way to do that is to go to talkingrealmoney.com and click on the contact button there. Either type it or speak it. Let's go to another spoken one.
Hi, Tom and Don. My name is Andrew, and I'm calling you with a question or a statement, really, about something I did that I know you don't agree with. I'm a long-term investor, and I'm set up 65-35 stocks and bonds. I'm pretty comfortable with that. Back in March, when all this tariff messing started, my wife and I decided that we would put a limit order in to purchase VOO if the market dropped 15%. And we figured out what a 15% drop would have been from the all-time high of the market and what that would have related to in that fund. And if this didn't happen, we weren't going to do anything. And it did happen. And a side note on this is when it happened, our balance was out of whack. We were at 61% stock, 39% bonds. So it made sense. This put us back into balance. Now, my plan is to hold this until the market returns to its old high and then bounce back to my 65-35. Now, I've heard you say on the show you're not fans of limit orders and you're not fans of timing the market. But I think if you time the market in a controlled, logical way and use limit orders, you can come out ahead. And I came out ahead quite a bit. I mean, I am looking at a nice gain on this move. So anyway, I'll stop and let you make a comment about this.
Well, first, they call this anecdotal evidence. And anecdotal evidence isn't really evidence. It's just a story of luck. And that's what your story is. It's a story of luck. And by the way, since you posted this question, the market hit another all-time high. So according to your system, you should have been out. Did you get out? I don't know if you got out or not. But I'm a little confused because you said it just happened to work out that you buying VOO put you back at 65.35, that you were at 61.39. So if you were at 65.35 and we hit an all-time high recently, wouldn't you, by selling, reduce your equity position? I don't know. I'm just saying. Just having the right portfolio mix and rebalancing regularly accomplishes the same thing without all the complexity and confusion of limit orders. I mean, I don't see the benefit of them. Yeah, it got you in when the market was down 15%, but you could have just put money in at that point. You could have been putting money in all along, and as you earn it. I don't see where the big benefit occurred, and maybe it's more luck than anything. What if the market never again went back down that 15? What if it just never did that? It just kept going up and it surpassed that previous 15. You would have missed out on all that return. Sounds more like you got lucky. to me. I mean, having done this for a while. And the proof is in the actual academic evidence. There is no evidence that individuals can come up with a disciplined system, even it's like yours, as simple as yours is, and beat the market. Because the market is very likely to do something to you that's going to mess up your system. As I said, when you put that limit order in, what if it never got back down to that number? Which has happened in the past. Just hasn't gotten back down to that previous low because it's now exceeded it and gone on to all-time new highs, which it will always do in any scenario short of an economic collapse globally. So, no, I don't like it. But, hey, if it works for you, it's okay to do stuff that works for you. You're just not going to get us to recommend it to anybody else. Thanks for your question. Now it's time for another.
Hi, Don and Tom. Appreciate the show. I have a quick question. If you invest in a company that's about to be listed on the S&P 500, historically, does it increase? I would think as soon as it's added, because of all the index funds and so forth, it would go up and be a sure bet. What do you guys think?
Well, it wouldn't be a bet if it was sure. There's no such thing as a sure bet. Bets are, by definition, risky. And this is a risky strategy. I know it seems, on paper, to make a whole lot of sense because when a stock gets included in the S&P 500, all of the S&P 500 passive funds out there must buy it on the day it's added. The index funds. Now, those that have rules-based like Dimensional and Avantis, they don't have to buy on the day. They could go out and buy the day of the announcement if they wanted to, just adding it to their large cap. And that's the key. It's the timing of the buy. And the odds are not good that you are going to be able to front-run the institutions and the hedge funds that find out about a stock being included in the S&P 500 at 12:01 and have already built a massive position of it by 12:01 and 30 seconds. And most of the big gain between the announcement of an S&P 500 edition and the inclusion in the index happens in that first day or so. In the subsequent days, it wears off. And over months, unless your timing is impeccable, you got to get in really fast and then get out really fast. You could wait as long as a few days after it gets included, but if you wait too long, in many cases, that S&P premium vanishes. I mean, it happened like with Tesla when it got included. I believe Tesla went up first day like 8%, but within a few months, it was back down to underperforming the S&P 500. So it's a quick thing. But we never, ever, ever stop wishing for the magic formula for wealth, do we? It just doesn't exist. You can't play the game. Not as an individual. You can't. You're going to get killed by the billionaires out there and the billion-dollar hedge funds and money managers. They're going to kill you. It's their job to, figuratively, kill you. Not kill you like in Squid Game, but figuratively. And whoa, look at how we're doing. Well, let's see. Will we make it to 6 questions within the time limit? Let's go to the next one, shall we?
This is KC, metronome from Albuquerque, New Mexico. Hey, I was just calling with a quick question. Whenever you guys mention rebalancing your portfolio, does that mean rebalancing going from international to domestic, small cap to large cap, or does that mean like going from stocks to bonds to other type of safer or more risky investments? Thanks for all your help. Good day.
Okay, you mentioned it was a metronome and you're in Albuquerque, but why Do you have a metronome going in the background? That's my question. What is are you just saying the show doesn't have enough rhythm? And the answer to your question is all of the above. Every single one of those things should be a part of a rebalancing strategy. If let's say you have a 50-50 U.S. to international portfolio of stocks, and the U.S. gets to 60 and the international gets to 40. You need to sell some of the U.S., buy some of the international to get back to 50-50. Same goes for growth versus value, small versus large, stocks versus bonds. All of those should remain in the originally intended balance on a regular basis. It doesn't have to be done really often. At least every year you need to look. And if you get way out of balance, you sell your winners, you buy your losers. That forces you to sell high and buy low, which is what we want to do as investors. And since there's no way for us to consistently and predictably do it, we force ourselves to do it through rebalancing of every asset class in the portfolio. And enjoy your ticking sound. It sounds like a bomb's about to go off. Would somebody please disarm this bomb? 855-935-TALK is a really important phone number because that's the number you use to call us on Saturdays when we take your calls and have a conversation with you live. Otherwise, go to talkingrealmoney.com, click on the contact form, and leave your questions there. And what are we at? Are we at 6? My goodness, we are. Look at that. We did it. Here's number 6.
Hey there, Tom and Don. This is Eric. I'm a big fan of the show. I had a question about inherited IRAs. I know there's a 10-year withdrawal rule. What I am curious about is if I hypothetically make $100,000 a year and I have to withdraw $10,000 from an inherited IRA, can I then just put that $10,000 back into my IRA so that I have taken the $10,000, it is added to my taxable income, so my taxable income is now $110,000, and then I take the deduction for having contributed to my IRA of $10,000, or I guess it would make more sense in a 401k since there's a contribution limit of only $7,000 for the IRA. But yeah, can you just withdraw it from the inherited IRA and put it back into a regular 401k or IRA, take the income on the one end and then take the deduction on the other end? It's been confusing me for a little bit and I was just curious. Thanks so much.
You found a way to game the system. Congratulations. Yeah, if you don't otherwise have the money to fund your IRA and you've got money coming out of a inherited IRA, you've got to take that money out within 10 years. So if it's $100,000, you could take $10,000 out a year, as long as the 100's gone in 10 years, and that $10,000 can do anything you want it to do. So it can go into your IRA up to the deductible IRA limits. It can go into your 401k up to the deductible 401k limits. And you are then, in essence, getting a tax deduction to offset your taxable gain or your taxable income from the required distribution from the inherited IRA. So yes, you have found a way to pay your tax and get it back later, or pay your tax and get it too. I was trying to do the cake and eat it too, but that didn't work out so well. Yeah, absolutely. Congratulations on finding that. And thanks for the call. Thanks for listening to the podcast. Thank you all for the calls and for listening to the podcast. And I truly appreciate you being there. If you get a chance, please tell folks about the show, because this is not something we want to keep to ourselves. The more who listen, the better it is for everybody, all of us, because the more who listen, the longer we're going to stick around. So let's get those numbers up. Spread the word. Thanks again. If you have any questions, go to talkingrealmoney.com, submit them on the contact form, or call us on Saturdays at 855-935-TALK between 3 and 5 p.m. Eastern. Saturdays, 855-935-TALK. I'm Don McDonald, and I love spending time with you talking real money.
The opinions and views expressed in this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions.
Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy.
Information presented on the podcast is not personalized investment advice from Appellate Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appellate Wealth, a fee-only registered investment advisor.
Please see Appellate Wealth's ADV Part 2A on our website for information regarding Appellate's fees and services.
Appellate Capital, LLC, DBA Appellate Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appellate does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit talkingrealmoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. I think I need a nap.